Many people who you know that are extremely successful from a standard of how much money they're taking home, because of how they file their taxes, have a very difficult time getting a mortgage. And that is actually right now a huge chunk of my business. Take the nursing home administrator as an example, self-employed. But now that he's self-employed, he's all excited. He's taking advantage of expensing his gifts, expensing his car, expensing his... Next thing you know, there's not that much money there on paper. But he's making a good living. How does he buy the home? That is where I've been very busy lately.
So what do you do?
So, all right, so...
Welcome to the Middle Class Podcast. Today we have a special guest, Gabe Tenenberg, Mortgage Gabe of FM Home Loans. And Gabe Tenenberg deals a lot with the middle class, helping them with mortgages, providing the valued service from step one all the way to the end, A to Z, getting the mortgage. And we want to go into the weeds today to understand how the middle class gets mortgages. So let's start a little bit with an introduction, Gabe, about yourself, what you do on a daily basis, and we'll take it from there.
Okay. So as you said, my name is Gabe Tenenberg. I haven't legally changed it to Mortgage Gabe yet, although that is how most people refer to me. I've been doing mortgages for almost a decade, which reminds me of a story. When I was in high school, we had a janitor. We asked him how long he's been here, and he said, 19 years, almost a decade. So I've had a lot of experience, and, you know, dealing with the middle class is probably my bread and butter. You know, we obviously help people with investments, and we help people who are not necessarily in those classes, rarely below those classes, because it just doesn't work. Right. So that's the struggle that I'm dealing with. You know, it's time consuming, and it takes a lot of energy, and people need to be able to understand what it takes to get it done, and that's what we've been grinding through.
So I hear a couple of major emphases, if that's a word, emphases that you said. So there's the struggle, like you said. Automatically, it's a struggle. Usually when, you know, we look online or in the non-Jewish world, home buying is this paradise. Let's get a home, our first home. For us, it's a struggle. It requires investment of time and resources, and like you said, get people through the grind. What makes it a struggle and a grind for the middle class?
Well, we're going to focus on how it's a struggle, but let's not forget that it is very exciting. I always appreciate the excitement when I get to help someone buy a home, they move in, and anyone who's listening who has dealt with me may have heard this expression where I tell them, you're not here to buy a home so you can sit on the couch and pull out whatever hair you have left. That's obviously not the goal. But it is a struggle mainly because, as you know, I'm sure you've discussed this with thousands of people, expenses are very high in our culture, and it doesn't leave over that much room for whatever that monthly payment's going to be on a mortgage in the communities that you want to buy. Mm-hmm. So this isn't a go buy out of town type of podcast right now. We're just trying to try to deal with how people navigate and get this done. In most cases, it's a struggle. And, you know, I always say 7 times a week, I get asked the question of how does everyone do it? And it comes usually after we get to that point of what it's going to cost. There's a little pause. How does everyone else do it?
Mm-hmm. And that's an important thing. So a lot of people ask me as the financial planner, should I move out of town? Should I not move out of town? So let's talk about in town. And what is the typical price of a move-in property or house in town that you're dealing with?
So in town is also a broad, term. Because I will say I do mortgages in, Houston, Texas, and Bala Cynwyd, Pennsylvania, and Boynton Beach, Florida, and you name it. However, in town, let's call it the tri-state area.
Yeah,
you have
New York,
the Muncie, Nanuet, New City, Haverstraw crew. You have the Jackson, Toms River, Howell, Brick, and whatever city just popped up as we're speaking. And then you have the 5 towns, let's say. You have the North Woodmere, the Far Rockaway, the whatever. There's a big range, but it's crazy how it's very normal for purchase prices to be north of $1 million for a regular middle class couple in today's day and age.
Mm-hmm. North of $1 million.
North of $1 million.
So, just everyone should digest that if they haven't yet. Every house or a lot of the houses in these in-town areas are more than $1 million. $1 million homes. So I read the Wall Street Journal and I look at these celebrities who are selling their houses for like $2.3 million in Palm Beach Springs or something like that. By us, it's in town, $1 million, the normal number that you're seeing?
Close to the shul, near the friends, already established, not on a far out block that doesn't have, the peers that you're looking to be together with. Unfortunately, it's a lot. It's a lot.
Now, just a quick question, fact check over here. What is the mansion tax?
So mansion tax it's a one-time fee. Whenever you buy a house that's $1 million or more, and yes, you'll see many homes selling for $999,999,999. But if it's $1 million or more, there's a 1% tax. And it changes in tiers if it gets way more than that. In Jersey, they switch the rules, who has to pay that. But the bottom line is there's a one-time fee that adds to your closing costs. And again, we'll get to that at some point, but savings and how much money people have for their down payment, they oftentimes forget closing costs. Closing costs are a fortune. Differs from state, differs by county. And when you're buying a home for 1.1, there's an $11,000 fee added onto your closing costs. Now, $11,000 for most people, it's not pocket change, and that takes a big toll.
And that number is not just on a structure. Let's say you're buying a property without a house. There's also a mansion tax of.
Technically, there would be. I believe so. I don't do those. I don't do mortgages on lands really, so I wouldn't know. It's not something that I have to check my phone.
No, I mean like someone's buying like this again. Facts. People are buying houses that are not move-in ready.
It doesn't make a difference, right? If you're buying a house that you say, I know over the next 5 years I'm going to have to put, I'm making up a number, $200,000 to repair this home, not to make it a luxury home, to repair this home so it fits my family's needs, you're still paying that. Even though, I find it funny, it's called a mansion tax. It shouldn't be called a mansion tax anymore.
Right, that's the irony. It's not a mansion, it could be a knockdown, and you'll still pay the same.
Exactly.
So let's talk about this, because a lot of people that I work with in financial planning don't know the basics of a mortgage, and the first time they go through the journey, it really is a journey, and I would love to just educate people on basics. So let's say a couple's coming to you. We use Moshe and Chani.
Perfect.
Gross.
Perfect.
Come to Gabe, Tenenberg, Mortgage Gabe. They're looking for a house. Well, do you help them find? Do people come to you just to say, well, where can we buy? Is that
so I always say the best time to get pre-approved to buy a home is really yesterday. Oftentimes I've had people, I remember the people who called me up from the car outside of an open house that they happened to drive by on the way to a friend's barbecue and said, wow, look at that house. They go in and they love it, right? It's the Lexus dealership. They go in, they feel the car. This is nice. They come back to the car and they say, can we buy this? And they call me up and now it's a scramble. Let's see if you can, A, get approved for a mortgage. Wow. B, once you understand what it's going to cost, can you figure it out, knowing that this seller is going to have 12 people put offers in over the course of the next week, and you got to make up your mind. So it's always smart to get these things done well in advance. But usually people need to figure out like, what's my budget? And it's a two-part question, because I can tell someone what they can get approved for. I can't dictate what they can afford. Everybody has different habits. One person can afford, you can have two people both making the same $250,000 salary. One person can afford this, the other person can't. This person's more conscious of their spending. They're able to adjust. The other person is more frivolous, is not able to, maybe took on more debt throughout their life. And that is something that I'll help them talk through, but I'm not a financial planner. I know of a couple good financial planners.
Very good, very good. But, thanks for the ad.
No, but that's the reality. We got to go through it with them so they can understand. And then oftentimes I'll tell them, now it's your turn to go home on Motzei Shabbos, sit down, look over the past 6 months, see what you've been spending on your rent, see if there's any extra money, see where you could potentially cut corners, and try to see, okay, where can we push ourselves to? Where can we make this, we'll call it a luxury of buying a home, doable or not?
So let's talk about the pre-approval process. And I'm telling you, because I have people reach out to me who say, I want to buy a home, I don't know what I'm supposed to do.
Right.
I want to buy a home. I don't know what I'm supposed to do.
Just to cut you off, I would say 8 out of 10 people, maybe 8.5 out of 10 people call me up and say, Gabe, I'm just letting you know right now, we've never done this before, so we're going to ask questions that sound stupid.
Right.
And I say, well, guess what? So does everyone else.
Yeah.
Nobody buys a home for their first time and has any clue about what's going on. Maybe now with AI, you can quickly get a quick summary, but in general, that's the way it is. People don't really plan for this so far in advance, and they have no clue what's going on.
People should hear that, because I like when people understand what's out there, that you're not alone and not knowing or having any idea what to do.
Which is that question which is that comment that we discussed is, how is everyone else doing it? It's, everybody needs to know that everyone else is going through the same, we'll call it struggles, even though I don't want to focus too much on that. And there's ways to go through it and figure it out.
Okay, so let's get very factual in the weeds. So what is the pre-approval process? So you have someone, again, who's coming to you, Moshe and Chani Gross, come to Gabe. We want to get a mortgage. There's a pre-approval process. What is that?
So I'm going to make up jobs for these two people. Now, the process for me needs to understand, what are they doing for an income? Are they learning? Are they in school? Are they working? Are they starting, do they run a business? Let's just assume, for argument's sake, that Chani is an accountant and she has a set salary. She gets a bonus periodically. And Moshe is, let's call him, a nursing home administrator. He's been in the business for 4 years. He's got his eyes on the gold, but he's been in the business for 4 years. He's got a set salary. He's got performance bonuses that he can get if he meets certain criteria. They come to me and they want to figure out if they could buy a certain home. So there's a few, I actually break it down. It's called the CIA. Okay. CIA. What's CIA? Credit, income, and assets. Mm-hmm. Those are the 3 pillars for what it really takes to get to see if you can get approved for a mortgage. The credit is crucial. For everyone who's applying for credit cards constantly with all those sign-up bonuses, take a deep breath for a minute. Mm-hmm. What your score is makes a massive impact. It makes such a massive impact on what type of rate you're going to get, what type of product you could even get into.
Really?
Some of the loans that are called jumbo loans have minimum requirements. And if your score is a 719 and you're trying to buy a home putting down X amount, you can't even get a loan with them.
Really?
So the score, massive impact.
Well, let me cut you off. What is the factor there? You were saying the credit score to get more credit cards helps or it doesn't help?
No, it could hurt. Meaning there's people who will constantly sign up and they're going to try to spend a lot on their credit cards, whether they're part of buying groups or whatever it may be. I've had people who come to me and will run their credit and their scores are really bad. They have, 7 credit cards, they're maxed out. Now they're paying those bills on time, but when that information gets sent over to the credit bureaus, all of a sudden there's a very high utilization and they don't have good scores.
Oh, really? So a lot of people ask me about that. I don't have an answer. Now I know. Getting more credit cards doesn't necessarily help your credit. But you do, having a credit card
that's crucial. That's crucial. Crucial. Not only that, let's say someone, and this is a very common occurrence I have, someone who, let's say, was a Canadian citizen, got married to an American, moved to America, and they never had credit. And they slowly tap on, they become an authorized user on this card. They finally get their first credit card. 7 months, they want to buy a home. Many lenders, specific types, depending on what they need, have a minimum length of history that needs to be for that credit to be even looked at. So you can have an 812 credit score, but if you have one Chase Sapphire card that was opened up 7 months ago, you're now limited to what type of loans you can get.
And how would that translate? I don't know if we should get too into this. You tell me where to stop. But how does it, give me an example of how having a good credit could get you this, and if you don't, where you...
So I'll tell you where I see it the biggest, or the most. We're not doing grammar, right? The place where I see it the most is with what's called private mortgage insurance. Now, we're jumping all around in the mortgage process. I'll leave the editing up to you to piece it back together. But most people are not putting 20% down when they buy their homes. Mm-hmm. Most people. When I say most, I would say over 70% of the clients that I deal with, first-time homebuyers, are not putting 20% down. Mm-hmm. Stereotypically, everyone thinks that's like the standard.
Right.
And the banks appreciate that. That's where they feel the most comfortable. When you've invested and have skin in the game, so to speak, they feel okay giving you 80% of this $1 million purchase, which is $800,000. Mm-hmm. That PMI, so say someone puts 10% down, and it's a little riskier from the bank's perspective. They're okay with it as long as you have what's called private mortgage insurance. Okay. You get it through the bank, they set it up, and it's essentially an extra monthly fee that is typically on there till the loan reaches a certain level of paying down the principal. And that's basically, it's a taking away the risk, taking off the edge from the bank. Mm-hmm. So what are they looking at on that PMI? The quote, how much is that? It's sensitive to each person. Mm-hmm. What's their credit like? Mm-hmm. How easily are they getting approved or how difficult are they getting approved? So there's criteria they look at, and also, is this person putting 5% down or putting 15% down? Are they close to our threshold, or are they very far away? So that's where I see it the most. I'll have people that'll come to me, they've only saved up, they have enough for 5%, but all of a sudden the credit's a 693, and that really can hurt them.
Okay, so let's say, for example, we hear that the Fed lowers interest rates, and I know we're jumping around, but I'm still in the pre-approval, let's say, process. So the Fed lowers interest rates they're at 6.2%. You're saying that someone's credit might be that they won't get that 6.2%.
So first, we gotta hit the brakes.
Okay, all right. Am I going too fast?
No. You're not going too fast. It's just you mentioned a trigger word, which is the Feds, which is the Feds cutting rates, and that's when my phone, which I don't know when this is going to be released based on when there's a Fed meeting, but it always blows up when they either raise or lower the interest rate. That's not mortgage rates. That's the Fed fund rate. That usually will translate into interest rates moving, but oftentimes you'll see the Feds cutting the rates a little bit, and then all of a sudden you'll see mortgage rates going up. Like, what happened?
Yeah.
It's a different rate. That's for the overnight rate, not mortgage rates, which are more longer-term debt.
Right.
And there's a different outlook. But again, we'll just assume the premise of 6.2 and go back to your question, which your question was, how could that differ? You can have two people buying a home.
Right.
One person has a 690 credit. One person has a 792 credit. And their interest rate could be a difference of 0.375. Which on an $800,000 loan we're already north of $100 per month. So there you go. Just like that, by being frivolous and not being on top of your credit, you made a massive difference in your mortgage.
Wow. All right, everyone should hear that. Credit.
That's the C. That's the credit.
The C. All right, moving along to
the I. That's where it's the nitty gritty. The income's the nitty gritty. Everybody's different here. I don't want to make it exclusive to our community, but oftentimes the salary jobs don't cut it. And you have people doing a lot of different things. And, people will call me up kind of bashful saying, my tax returns don't show much income. I promise I'm earning. And that's common. But assuming the scenario we played where she's an accountant, he's a nursing home administrator, and they're making their salary. So the first thing I do is I take that, I divide that number by 12. The bank looks at the gross when you're salaried. So the gross number, I forgot the numbers I gave you, but let's just say it was a total of 360. Because that's divided by 12. 360, middle class, $30K per month. Great. $30K per month. This is going to shock most people. The banks will approve someone for a mortgage in most cases where that monthly payment on a mortgage. Now, what does a monthly payment on a mortgage typically consist of? On a regular home, your mortgage payment, which is known as the principal and interest, property taxes, which differs, out in Muncie, it could be who knows where. Woodsburg, New York is who knows what. Inwood, much less. New York City could be less. It differs based on where you are. And then your insurance. And insurance also. Home insurance has, unfortunately, over the years, has gone up with inflation, with cost of everything. Insurance keeps going up. Flood insurance, depending on where you're buying. Those are the four main things. Your principal and interest, which is your mortgage, your tax insurance. As long as that number, along with whatever else came up as your recurring liabilities on your credit, not your life insurance payments, not your school tuition payments, not your subscription to who knows what payments, 24/6. Bottom line is, as long as that monthly payment with the recurring liabilities that we see on your credit does not exceed, in some cases, 50% of that number, which again, 30,000, it's 14,999. You would be good to go. Now, any financial planner, and I can speak for all financial planners, any financial planner who hears that someone is, let's say, putting themselves into a position where their monthly recurring credit card debts and stuff they have on their credit report, car lease, student loans, along with their mortgage is just at 50% of their gross income.
Yeah.
That doesn't work.
No. I mean, let's think their net income.
Exactly. Well, again, exactly. And the net income differs where you are. Right. You're in Boynton Beach, Florida. Your net income is going to be different if you're living in Far Rockaway, New York, where you're going to be hammered. Right. So it does differ. But even in those cases, that 50% number is a very tight number. But still, that is the standard guideline for most mortgages that
Interesting. So it's not really hard, if I could say it like this, it's not hard to get approved. If you're making a middle-class income?
If you're making...
with a pretty good credit?
If you're making what we classify as a middle-class income...
Yes.
Under the terms that we discuss, which salary is not, making it the more complicated ways where the tax returns don't necessarily show that you're making that money. But assuming you're making the money the way the middle class is making the money, it is not so hard to get approved. Now, to get pre-afford, as we call it.
Pre-affording.
That
interesting.
Is a whole different story.
So let's talk about that, because I know with my clients as well, of course, everything is kosher v'yosher. But the tax return doesn't necessarily reflect all the cash flow.
Correct.
So what do you, because that's a very common
Very
scenario.
common.
So
very
what
common.
are we doing?
So
in
there's
this
a few
situation?
things that, the banks understand are paper losses. So like all the guys in real estate that have the depreciation, the accelerated depreciation, that's a paper loss. Now, it differs from program to program, how lenient they are with adding that back, so to speak. But that's one thing that they kind of recognize. And then you have like something I hear constantly from business owners is, I'm just letting you know that, at the end of the year, we pay a lot of our vendors and try to offload as much as possible. And I let them say it, and then I say, I've heard that a million times. Right. Many of them have a very hard time getting a mortgage. Many of them, many people who that are extremely successful from a standard of how much money they're taking home, because of how they file their taxes, have a very difficult time getting a mortgage. And that is actually right now a huge chunk of my business is dealing with people that are self-employed. Some of them more recently opened up businesses. We'll take the nursing home administrator as an example. He was working as an admin for 6 years, branched out on his own, became an operator with some people, and now he's self-employed. But now that he's self-employed, he's all excited. He's taking advantage of expensing his gifts, expensing his car, expensing his... Next thing you know, there's not that much money there on paper. But he's making a good living. How does he buy the home? That is where I've been very busy lately.
So what do you do?
Sorry.
You can tell me that this is censored.
No, so for that, there's a very popular program right now. It's called a business bank statement loan. Slow down.
Okay.
The banks understand that not necessarily what lists your income on your tax return is what you're actually making. There's an understanding. But they need to get an idea of how they can evaluate your income. So what they'll do is they'll take we'll call it a T12, but they'll take 12 months of your business bank statements. Some cases you could do personal if people are paid differently. And they'll essentially determine your income just based off the deposits that are coming in. Now, there's rules to it. It works very favorably for some industries, a little tougher for others, but they're very focused on deposits. So you have people, one of my biggest clients are Amazon sellers because there's a lot of deposits. There's a lot of deposits coming in. And even though the tax return may show $100,000, when they do the approval through the bank statements, all of a sudden there's, 1.6 million of income. So there's a lot more. So that's a big chunk of my business right now, is the business bank statement loans. A lot of people out there are not even entertaining buying homes because they think there's just no way they can do it. Like example, a guy's opened a business 17 months ago, and he knows that his first year he went crazy with expenses, crazy.
Right.
And he's gearing up for another year of it. He's gearing up. He's already, tax planning. He's doing what he's got to do, but he's making money.
I would say, if I could, take a step back for a second, that I feel what I'm taking from this conversation is that this is why it's very important to have a good broker.
100%.
Right? Because
but it's not only about having a good broker, it's about realizing you need to make the call before you think you need to make the call. That's also, sometimes it's just about like people assuming certain things, right? What they always say about assume. People assume certain things and they just don't make the call. You make the call, you get that light, and all of a sudden you realize, wait a minute, I could have done this. And I've had many people who realized too late in the game, and as they waited, the home prices kept going up. The communities they wanted to move to, where their friends were, the homes started selling out. And the next thing you know, now that they make their decision, in hindsight, they should have pulled the trigger a few years ago.
And so you're saying, I know it's very important, people, like we said, with the interest rates and how that works. I do hear that from what you're saying, that it's still, if you're in the situation where you want to and can, let's say, buy a house, you should just do it, so to speak.
Yeah, again, I hate to push people off a cliff, but very few people that I've worked with that push the envelope, so to speak, within reason. Reason. It can't be reckless, but push the envelope. Did not regret the home they bought, realizing now that the neighbors, they don't know how the neighbors who are moving in 2 years later are affording the home that they bought 2 years ago. And remember, when you buy a house with a mortgage, you're hedged. Your cost is what your cost was then. Your loan is typically fixed. As the prices go up, you're hedged. You're protected. Maybe you'll catch a win where you can refinance and make your payment even lower. They don't adjust what your sale price is then, even though the neighboring homes are selling for 150 times that price. You're good. You're locked in. So most people most people are able to make the move. And that's something I do try to like passive aggressively push on people. Like I just had a conversation with someone on Friday. I'm not going to give the date because I don't know when this is getting released, but on Friday where I spoke to a guy and I said, he was trying to manage, he had bought a home 3-4 years ago. Great move. The area he bought in, the homes went up. Now he's figuring out, can he move and buy somewhere else? He'll sell his house for a nice amount, but he's going to have to pay a nice amount for the next home. His payments will go up. So he's trying to figure out what's appropriate. And when I went through the numbers with him, he's like, oh, that's a big jump. And I said, do me a favor. How about over the next 6 months, you manually take, let's call it $700 a month out of your account and pretend like that is your new housing expense. Just pretend and see if you can survive after 6 months. While you're at it, put it in a good investment, let it grow a little bit, and then see. Because oftentimes, what I find, people kind of adapt and conform to their housing budget. So when they have a rent of $2,700, they'll go out to eat. They'll buy the new sneakers. They'll do what they need to do. But if their mortgage now is $4,300, they're going to they're not going to run in and grab that roll of sushi. They're not going to go buy the new pair of shoes. They're going to squeeze into that sweater that doesn't fit so much. They're going to make it work. So put yourself in that situation and see if you can push it and see if you can do it.
So I also want to emphasize, because that's a concept in planning also, that when you hear, let's say, I don't know, a $5,000 a month mortgage, understand that you're not adding $5,000.
Correct.
The difference between the housing budget, like you said, and the rental payments. So it's a gap of, let's say, $2,000 to $3,000 a month, which is much more doable.
Correct. Right? Yeah, that's a very, I always like to focus and before that, there's always a sticker shock, like we said, the $1 million home. People get sticker shocked by that. Well, let's break it down first.
Yeah.
How much you putting down? What's that monthly payment? What's your rent? And also, where do you see yourself for the next 2-3 years? You think your rent's going to stay the same? Are you going to fit in this 3-bedroom home the next 2-3 years? Or is there going to be a inflated rent that you're going to have to deal with there as well? So let's try to, again, I can't foresee everything, but let's try to see if we can somewhat bring that number to something that you can actually achieve.
Exactly. So $1 million house sounds like, crazy with a mansion tax and celebrities, but the truth is you break it down, also keeping in mind that our middle class is technically upper class. It ends up being very doable. Back to Moshe and Chani Gross, who are getting a lovely couple at this point. They're excited about their house. So they're buying $1 million house in Inwood, New York, okay?
Let's assume they're putting 20% down. Just to take out the PMI factor, which is another added element of monthly expense.
Another complication. So assume they're putting down the money.
Chani's grandfather.
I was going to get to that point. Hold the thought.
Okay.
We're going to get to the family help question, which has been a theme on this podcast.
Yeah.
So they're putting down $200,000 he saved from babysitting over many years.
He also tutored at night.
He tutored at night. He did side hustles. He sold sourdough. Okay, so they have $200,000. They put it down, $800,000 loan. What kind of numbers are we looking at for the mortgage?
So again, it's going to differ based on rates. So let's ballpark it based on where rates are today. I'm going to use a ballpark 6% rate, which is about a $4,800 monthly payment. Again, that's just the mortgage, no taxes, no home insurance. $4,800 a month.
$4,800.
Let's assume their home has, let's say, $12,000 a year taxes, just because it's easy, although that's high for Inwood. Tack an extra $1,000 on top of that.
Okay.
Down to $5,800.
Okay.
Home insurance, it's getting more expensive. We'll use $2,400 because, again, easy math. Tack on that $200 a month, $6,000 a month payment.
Okay, and we're assuming their rent is $27,000. They have 4 kids.
No, where are they getting $2,700 a month rent?
Go ahead. Yeah,
they live in Far-Rockaway, I'm assuming.
Let's say they're
moving to Inwood.
Yeah, they're moving. They don't like Far-Rockaway.
I would say they're probably, let's say they're 30. Let's say $3,100 a month.
$3,100.
Yeah.
So the gap again now is $2,900. Doesn't sound.
Remember, some of that is paying down the money, the $800,000, which is towards the home that they're going to own. So, I don't want to get into the whole rent versus own, but also remember, it's not really apples to apples because you are buying an asset that will be yours forever.
It's not money spent, it's money saved or invested.
Correct.
And I can tell you from the back end of working with people and their plans, when they have a house, it's an asset, they can borrow against it.
Now, it may be a pain in the asset, but it's a good asset.
Yes, that was the word I was looking for. Over time, though, you get a lot of equity. Right. And when you do put down, you get a certain percentage. Yeah, home is definitely an asset. Okay, so we're moving along in the pre-approval process. We get approved for this $800,000 loan. Did we get into what the A is again?
The A is the assets.
The assets.
That's where, again, I don't know if you want to get into this, where are people getting their assets, but
Oh,
how much money you have is important, not because they care about your net worth, so to speak. It's because you need to contribute, like we said. A person, again, the C is the credit, the I is the income, which gets very complicated in our communities. The A is the asset, is you need to contribute something towards this purchase. How much that is going to determine what type of loan, and obviously what your monthly payment is. You put less down, you're borrowing more, and then you also have, on most loans, the PMI added on top.
interesting.
But like I tell people, most of my clients, and it's not like 51%, it's closer to probably 80, are putting less than 15% down even.
Wow. And that's the crazy thing, because when I was in economics school and CFP school, financial planning school, PMI was like this demon.
Oh, and
avoid it at all costs. You're saying?
I love it. I love PMI. It's the best thing ever. It's the best thing ever. Most people who took on loans,
that's crazy.
I'm telling you, most people who bought homes with PMI are way ahead of the game. Even though they paid $96 a month in PMI, some of them even refinanced their homes, and based on the new appreciated value, when they refinanced, the loan balance versus the new value didn't need PMI anymore. The bank's very happy with that. So PMI is the best tool that is out there today. I love it. I preach it. Not only do I preach it, I tell people, and I'm not a financial advisor, but I do preach this. Let's say someone comes to me with 20% down. Let's say with Moshe and Chani, they have 20% plus the closing costs. And the $6,000 payment, it's a little bit of a squeeze. They really want to move to that area, but it's a little bit of a squeeze. They can probably swing like $5,200.
Okay.
6,000 is a real squeeze. So they're like 800 short.
Okay.
There's a magical 800, and they crunched the numbers after Avos Sabanim on Matzah Shabbos. They went through everything. They looked at the past 6 months. They can't come up with that $800. What I tell them is, I say, calm down. Don't put down 20%. Put down 170. Keep $30,000 in your bank. So now you're borrowing, instead of 800, you're borrowing 830. Does your payment get a little bit more expensive? Yes. How's that helping them? Now, instead of being 6,000, don't correct me on the math here because I'm just going to throw it out there. All of a sudden, it's 6,215. Went up by $215, and they're added PMI of $47 a month on there. So now their payments, let's just say $6,300 a month. They're further away from that 5,200 number, but they're not, because they have $30,000 sitting in their bank. And Moshe knows, he's working really hard. He knows. He's got his eyes on the gold. He's pretty confident, based on his resume, how good he's been at his career, that his salary is going to be growing over the course of the next 2-3 years. So now you're good to go. Protect yourself. Take that $30,000, spread it out over 3 years. You buy in the community you want. Your kids start getting their friends. They can have their play dates on Shabbos instead of feeling like they're out of town. And over the course of the next 3 years, take that $30,000, make automatic transfers of, let's call it $800 a month. Do $1,000 the first year, $750 the second year, and then so on. And now you've just slowly bridged the gap into being in an affordable home by using our best friend, Mr. PMI.
Wow, I was really blown away by that. I would say, just to throw it out there to all the hardworking individuals, that a lot of times after we do financial plans, and maybe you can do this as well in mortgages, it's an incentive to get a raise a lot of times. Because if you see what you need to get a house, it's a house. It's like, that's unbelievable to buy a house. All you need to do is add on a little bit more income. It's a good incentive. Because I see a lot of people out there are underpaid, or they can get a raise. So just wanted to...
and I've seen that firsthand. I've had these numbers with people.
You've seen this.
And I've seen people take these numbers and go back to their boss and say, I need to buy a home in this area. It's going to cost me around this. What I'm earning is not going to make it. I need a raise of X. And most times it works.
That's valuable information.
Times it works.
Wow. You hear that? You listen to this podcast, you make money, right? That's it. What an investment. It's free. All right, so let's complete the mortgage process. So we have Moshe and Chani.
Moshe and Chani have just been pre-approved. Their income is good to go. We had to get all the documentation, their photo IDs, their W-2s, their pay stubs, their bank statements. They had to give a lot of information about where they live. They had their credit run. Their scores are good. And now they're pre-approved. Now, they don't have a specific house in most cases. They're looking in a general area. And now they reach out to a realtor and they say, all right, I've been pre-approved. We've also come to terms that we can afford this. We game planned. They took my advice. They're putting 170 down, not 200. They have that cushion. And then they start looking at homes, and every home will be different. I get people who I pre-approve who will text me for sometimes years because every house is different. Oh, we decided we're going to go to this area of Inwood where the taxes are higher, but it comes with flood insurance. This house needs work. We got to put less down. And you'll kind of shake it and bake it until you find that right one. But now you know at least that you're good to go. And it works both ways because like the car dealership example is what I always say is do not go into a Lexus car dealership. Do not walk in unless you are comfortable that you can actually afford them. Because the second you feel that leather and the second you smell that, you want it. But if you can't have it, you're going to end up getting yourself in trouble. So you get pre-approved before you start walking into open houses just for the free sushi or whatever, whatever they're giving and see that beautiful kitchen. If you can't get it, you can't get it. You got to first make sure to run the numbers to make sure you could. And sometimes people get surprised. Like the guy who was self-employed, who has a net income of $63,000 on his tax returns, but is really making well over triple digits. Now he can go in, he can buy that house.
Yeah, so to emphasize again, the whole pre-approval process can happen like before you even know of a house.
Correct.
So everyone who will buy a house, get pre-approved. I mean, isn't that like...
it's basics.
Like,
it's
do
basics.
it. It'll save you a headache, and then you can be that first buyer who bids to get the house, really. Okay, so you're saying after they get pre-approved, they find a house... What is the actual, I guess that's the closing process.
Right. Well, again, yeah, that's the process. They have to go to contract, meaning let's say, for example, the person wants $1 million.
And again, I'm sorry, but these are people who are really need to know ABCs.
Unfamiliar, right. So they can listen to this without feeling embarrassed that they're asking these questions. So they've been pre-approved. Now they contacted a realtor in whatever area they want to buy their home in, and they start putting offers on whatever homes they looked at that they like, and there's a negotiating process. It's not going to be the same because every house has a different seller, different realtors, how they negotiate it. You finally come to terms with what that price is. That's when they get their home inspection. They contact their attorney. There's going to be a contract drafted between the two parties. And there's usually a time frame once it's agreed upon where, okay, now you need to send a certain deposit towards that purchase. And then you have X amount of days to get your mortgage and close on that home. And that some people are closing 30 days. Some people are not closing for 5 months till the sellers move to Florida, whatever it may be. And that's going to be specific to each transaction. And you have some homes, which is common, and this is a term that probably people hear is, the mortgage contingency, which is what I was referencing, that timeline to get approved for your mortgage. You have, let's say, a home in Inwood that a bunch of people want. And we're using Inwood, New York as a reference right now just because we mentioned it before, but great block, great families on the block. It's near the shul, and it's in good condition, move-in ready. And you go to the open house, you see like a bunch of other people there, and you want this house. So people start putting in their offers, highest and best. Let me hear what you got. And sometimes you'll have multiple people putting the same amount down, and it's not necessarily that big of a difference. The one thing that I've dealt with very often is where buyers will waive their mortgage contingency. Extremely common. I deal with it all the time, puts the pressure on me. But essentially, what they do is they're buying this home without the mortgage contingency. What is a mortgage contingency? Mortgage contingency gives the buyer typically 30 days to 60 days to apply for their formal mortgage. This is past the pre-approval. Now they have a house, they have their money together, they're putting it all through underwriting now and having the actual stamp done for this specific house. They have 30 to 60 days to get that approval. And if, let's say, they get denied for whatever reason, something comes up, the appraisal of the home that the bank determines it's not worth what you're buying it for, and that shakes things up. Or who knows what it may be. It doesn't work anymore. You back out. Your attorney reaches out with a denial letter from the bank. You get your deposit back. So for a seller who's moving to North Carolina, they're on the edge of their seat until that 30, 60-day window happens. They're not going to sell their grandbaby piano. They're not going to donate their clothing to the poor yet. They want to make sure. So what people will do is they'll say, hey, I'm waiving my mortgage contingency. So for the seller, it's like, you know what? Your offer's $5,000 less than the other guy, but it comes with that certainty that I know you're not going to back out if, spaghetti hits the fan. And boom. So that is a very common occurrence. And again, it's the decision of the buyer if they want to do that. Obviously, they'll discuss it with their attorney. But in most cases, when they're doing it, they've been really vetted with their pre-approval, and they know that if anything comes up, it's something that was totally unpredictable, but they're willing to take that risk because...
Mortgage contingency. Wow. Okay, so again, let's just go through the bullet points. So we have the pre-approval, then to get the formal mortgage, and then again, just the steps in getting the closing. What is... the closing process.
The closing process, we'll back up, is you get that contract.
Right.
Your attorney is going to get title insurance on the home.
Title insurance.
Which is, you see all those companies. I'm not going to make any names now and have other people upset why I didn't mention their name. But title insurance.
The ones on the tissue box.
The attorney is going to order title insurance, which is an important component of buying your home and making sure that it's going to be yours and no issues can come up beyond that date. And then you're going to get homeowners insurance on the property locked up once you get
the broker, right?
with the homeowners insurance broker. And then most of it is actually done with your mortgage lender that's going to be going through the process with you. There's odds and ends. They need to document the money that you got from your great aunt Lisa in North Dakota. All those different steps to making sure you're good to go. And then there comes to a point through the process where everything has been, they've dotted the I's, they've crossed the T's, and now you're cleared to close. And then the attorneys coordinate the closing. Takes, anywhere from 40 minutes to 2 hours, signing a whole bunch of documents,
Right.
Which is that lovely note of now the new loan that you have, which you're making that lovely monthly payment with all the smiles, hiding the struggle, because we don't buy a house to pull our hair out in it.
That's right.
And then you own a home.
Right. All right, Gabe, it's been amazing. I'm going to wind down the conversation, but I want to get the PowerPoints from this conversation. How do people do it? Let's use our example, but break it down for us.
With Moshe and Chani. I think the example is, first of all, like what you touched upon, is people need to start getting pre-approved well before they're actually looking to buy the home. Because they have to get to terms with what that number is going to be. Don't look at the $1 million home. Look at the monthly payment. Try to get a feel for how much you have available. Because like I said, game planning with your money to maybe use some of it as a cushion will go much further than putting it towards your big down payment. And kind of adjusting your budget and almost making it as if you have that new mortgage payment every month to see if you can actually make it work and see how far you can stretch yourself. Because like we discussed, most people who pushed the envelope a little bit more than the other person ended up winning big time on the fact that they bought their home when they bought their home. And that took an element of kind of jumping off the cliff with the proper gear, but jumping off the cliff. And I think that's a crucial element of buying a home, is having that conversation, understanding that number, seeing where you can stretch yourself to. And hey, if it means you got to move out of town, you got to move out of town.
I hear from this conversation, what I would take out of it really is having a good mortgage broker. This is not an ad. We never discussed this. I really mean it. Having a good mortgage broker to take all of this off your brain, like title insurance and property taxes and PMI, just know that you have someone who you're trusting. That's, again, that's what I'm hearing. It's doable because you're filling in a gap. You owe to rent and you have to fill in a gap for a mortgage. You need to push yourself. There's strategies to do it. But this is all, good mortgage broker will give you the peace of mind to do it properly. So I want to thank you, Gabe, for coming on the show.
Thank you for having me on.
I learned a lot, and I'm sure a lot of people will learn and have learned as well. Feedback, again, is the most important thing. We want feedback. We want to hear from what people have to say. If they have questions, I could definitely give all your flooding emails to Gabe. I'll pass it on to him, flood his inbox. But thank you all for listening, and till next time.